Hey everyone, I hope this video message finds you well. In a few moments, we will begin our State of the Markets presentation with our Chief Investment Officer, myself, and Matthew Witt. But before we get to that, I want to address the concerns that I'm sure that you're feeling, given the recent tariff implications. I want to let you know that we understand that you're concerned, and we are here with you, and we don't take that lightly. We have your portfolio built out in a manner that will withstand the markets that we're currently in. We know when we built your fiscal house out, or your portfolio, if you will, that you are already retired or that you are nearing retirement. So all of your money is not in equities, but it's in different layers of the fiscal house. I hope you enjoy the video presentation. Please know that we are always here for you. Thank you.
Thank you so much for joining us. We'd like to welcome Tony Parrish. She's our Chief Investment Officer. He's got decades of experience in the field. I always feel less anxious and relieved after talking to Tony. So we hope to do some Q&As with Tony today to hopefully help us navigate some market uncertainty that's been going on recently.
Matt and Justin, thanks for having me today.
We're so glad that you're here, and we look forward to talking to you about what's going on and what your thoughts are on the market as we move forward in this 2025.
I think the kind of big hot topic item that's on everyone's mind, definitely the news cycle, is the tariffs. And it's really relevant time that we're doing this webinar with you because, yesterday was the day, right, where the tariffs were announced. We've talked to you about this before. You'd had a lot of good insight about how you feel the direction about how tariffs are impacting the markets and what we can expect.
What does the historical data show and the implication of having tariffs on the market? Or are we in uncharted territory?
I think that the biggest initiative by the new administration in 2025 is actually not. We're going to look back historically and see that tariffs weren't the biggest initiative. The biggest initiatives, I believe, are going to be the extension of the 2017 tax cuts. And that is, that's something that markets will generally cheer, investors will cheer. But the big issue about tax cuts is there needs to be a way to pay for the tax cuts. So one of the things that we've seen really cropping up in headlines lately is, this obsession by the media about tariffs and also about the Department of Governmental Efficiency. I think those two things, the tariffs, which raise revenues for the federal government, and the Department of Governmental Efficiency, which lower expenditures for the government, help to create a fiscal environment that will allow for the extension of the 2017 tax cuts. So right now we're in the middle of lots of discussions and lots of, breathless reporting on the tariffs. But I think that as time goes on, we will see tariffs as measures that have been put in place in order to partly to pay for tax cuts, which I believe are coming. This is one of those situations where I think it's important for investors to not react to the short term. Rather, it's important to have financial plans that are in place that can accommodate volatility. We're certainly in a period of volatility right now at the beginning of April 2025, but I think that as we go through the year, we are going to see some of this volatility subside, and investors who try and time the market, I think, are going to be making a mistake, considering it's very difficult to get out of the way in time and then get back in time in order to participate with some rallies. So what we're seeing right now is short-term volatility, but I believe that when we look back at the end of the year with the benefit of hindsight, we will have seen the current tariff chaos within a larger context, and that is a context of other initiatives that are more supportive to the market environment.
Yeah, and Tony, thank you for that answer. You kind of hit on another topic that we often get asked about, and about timing the market and getting out of the market and getting back into the market. They want to get out at the exact right time, and that's to put them back in at the exact right time. Talk to us a little bit about that. I know there was like 6 things that you say you have to get right.
Yeah, I think it's impossible for people to time the market correctly in a reliable way. And that's because, nobody in the world can time the market unless they are working with some kind of material non-public information. And to be trading on material non-public information, last I checked, is illegal. So law-abiding investors cannot time the market. I don't care who you are. You could be Warren Buffett and you're still not able to time the market correctly. Why is that? Well, it's because what ends up happening is people try and get out of the market as they see the markets are falling, and then get back into the market as they see markets are rising. But what ends up happening is markets come down and you sell, markets go up and you buy. In other words, you do what is the opposite of what you should be doing. You should be buying low, selling high, but instead you sell low and you buy high. And as I like to say, if you sell low and buy high repeatedly, you will go broke. So instead of just having a situation where you're reacting to the markets, it's better to have a financial plan in place, knowing that there are going to be, bulls and bears and cycles of the market. Know that in advance. Create the investment allocation that assumes that those things will take place, and refrain from reacting to short-term movements in the market. Specifically to your question, Justin, about 6 things that need to go right if you're going to time the market, that's true. If you're going to successfully time the market, you need to know when to sell, know what to sell, and know how much to sell. But then once you've sold, you're sitting in cash. You're not going to sit in cash for the rest of your investment horizon. So you also have to know when to buy, what to buy, and how much to buy. So that's 6 things, 3 on the way down, 3 on the way up that you need to get right. And if you get any one of those wrong, you can turn an otherwise profitable trading strategy into losses. So instead of trying to do that, build a plan, know that some storms are going to hit occasionally, and build the plan with enough robustness to weather the storms and stick with the plan. That's the advice.
Matt and I talk about all the time with our clients is, we've built your fiscal house and prepare it for a storm such as we're in now, if you want to view it that way. We've got money in safety. We've got money that will go up when the markets go up. We have some money in equities as well. But I think it's about time in the market and not timing the market. Matt, you've got a chart. If you would share that so Tony can kind of walk through that.
In this slide, I think it's a good representation of what investors should be thinking about when they think about their investments. The blue bars represent stocks, the lighter blue bars represent bonds, and the gray bars represent a combination of stocks and bonds, 60% stocks, 40% bonds. And that cluster of bars on the left-hand side shows over time the average 1-year range of stocks, bonds, and the 60-40 portfolio. And then the next cluster shows 5 years, and then 10 years, and then 20 years. What we see as we go from a 1-year snapshot to longer term snapshots is the volatility to the upside and downside compress. So why is this important? This is important because if we look at our investments with a very short-term myopic perspective, like 1 year, it looks like our investments are incredibly volatile. However, if we do nothing, if we just allow that myopic perspective to get broader and we hold our investments for longer periods of time, you see going from 1 year to 5 years, the range of drawdowns in the 1 year period was negative 37% at the most extreme, yet over the 5 year term was negative 2%. Short term stocks can drop, bonds can drop, a 60-40 portfolio can drop. But if we hold that same portfolio or investment for longer periods of time, the likelihood of a drop gets lower and lower. In fact, there has only been one rolling 10-year period in the history of the S&P 500 where your investment in the S&P 500 would have been negative. And that was 2000 through 2009 inclusive, those 10 years. And what did those 10 years include? The dot-com bubble bursting in 2000 and the global financial crisis in 2008, which bled into 2009. In other words, we had 2 crises in the stock market within that 10-year period, and that's the only 10-year period when the S&P 500 was ever down over that period of time. And if you go longer than 10 years, there has never been a time in the S&P 500 where it has been negative. So the bottom line for this chart is short-termism leads to a view that is exaggerated in terms of the extremes that can happen in the short term. But investors should rather look at a longer term view of their investments. And when they do, they will have a more proportionate sense of what the extremes are. The extremes get lower and the predictability of the outcome gets higher.
And so when we look at the 20-year rolling average, when you look at the 6% and the 18%, can you speak to what those numbers represent?
The range of returns over the 20-year period was from 6% annualized return at the low end to 18% annualized return at the high end. That's what that blue bar signifies on the right-hand side of the chart.
We look at the graph above, or the chart above rather, the average return for stocks over a 20-year period looks like it's 11.6. For bonds, it looks like 5.2. Is where 60% equity, 40% bond portfolio looks like about 9.4%. And I can hear what some of my clients, or our clients rather, are saying. Well, Justin, I'm 65 years old. I'm 70 years old. I'm 75 years old. I don't have 20 years potentially. And again, I want to reiterate, your portfolio is not all in equities. If we build out your fiscal house, only a small portion of it is in the equities, because we've got the walls, which are their structured notes, market linked CDs, and the foundation, which is our fixed index annuities, typically.
If there is a recession, worst case scenario, I think people think this recession, like the R word, is this terrible thing that's going to last for, an extreme amount of time. There's going to be extreme pain. Historically, if there is a recession, how long do they typically last? And what is the market performance in subsequent years?
Recessions are things that happen naturally, right? The economy is cyclical. There's boom cycles and bust cycles, and that is natural and to be expected, right? Just like the sun rises in the east and sets in the west, the economy is cyclical, just as the constellations are cyclical. I am reluctant to get into discussions about what is a typical recession and how do stocks perform, because we actually don't have a lot of data in the modern era for talking about recessions. For instance, we only had one recession since the global financial crisis in 2008, 2009, until COVID came along. In other words, we had 12 years of economic expansion before there was a recession, and the recession was very, very short, right? And then the economic expansion continued. So going all the way back to 2008, that's over the last 17 years, we've only had one very brief, short recession, and that tends to skew the numbers. I think we've had 17 recessions since World War II, but sometimes they're longer, sometimes they're shorter, sometimes the time in between is longer, sometimes it's shorter, sometimes they're deep and painful, sometimes they're relatively shallow and relatively painless. The important thing to know is that recessions happen. It's just part of the natural boom and bust cycle of the economy. And investors should have portfolios that are robust enough to withstand recessions. Investors shouldn't be reacting, shouldn't be radically adjusting their portfolios based on the economic environment. They shouldn't be adjusting their portfolios based on the headline or speculation of what's coming. Instead, investors should know that recessions do happen periodically, and they are to be expected. They are not life-ending events. It's not like a giant asteroid hitting the Earth, right? We, as long as we live for, the next 10 years, we're going to, in all likelihood, have at least one more recession, possibly multiple recessions. And that's okay. We just have to be prepared for it, have good diversification in our portfolio, work with financial professionals such as Matt and Justin at Dean Financial, make sure that there is, that we don't put all of our eggs in one basket, so we're not overly vulnerable to a recession when it happens. Notice I say when it happens, not if it happens. And then from there, have faith in the financial professional team that has worked with you, the investor, to ensure that you have the right investment portfolio to get you to those goals, to achieve those goals that you have using means that are comfortable to you. That's a much better approach than trying to bob and weave and maneuver your way about speculation of recessions that may be coming.
Gives me like comfort to hear, because when I think of recession, it's like an emotional response to that word. I think of 2008, like this is going to be awful. That's not necessarily historically the case.
Right. If you look at the last recession that we had in 2020, it was relatively brief. It seemed very painful at the time, but for all of those investors that rushed out of the market in March or April of 2020, if they didn't get back in right away in May of 2020, they missed out on an explosive rebound in the market. So that's an example of how investors trying to react to speculation of recession or speculation of market drawdown actually works against them. When I think about a mentor of mine years ago, I was in New York. I reported to this mentor who was in Boston. He was my boss, and he had a great sense of humor. One of the things he liked to do was quote old Scooby-Doo episodes. And he used to say, he used to give his own kind of spin on a Scooby-Doo quote. At times of crisis, he would say, "Don't just do something, sit there. Don't just do something, sit there." Now, that's an inversion of the Scooby-Doo quote, which is don't just sit there, do something, right? What he was saying, though, is very often when things are chaotic and when we feel like, something needs to be done, we jump into action. But at that time, we're often confusing activity with productivity, right? Being active doesn't necessarily mean we're being productive. And very often when markets are chaotic, they're selling off, there's speculation of recession, speculation of downturn. We jump in and we do something, and only later do we find out that what we did compounded some kind of error. So what he was saying when he said, "Don't just do something, sit there," was choosing to do nothing during times of chaos is a choice that often results in a better outcome than the outcome that is achieved if we try and react to the markets and then miss out on some kind of rebound. So don't just do something, sit there is a mantra that I've carried to the investment world that has actually served me very well over the years. Times of crisis are not the time to be changing your portfolio. If you're going to change your portfolio, do it in the calm, clear light of day when the markets are peaceful and you're doing so in a rational way that is meant to put in place the optimal allocation for the long term.
What are your thoughts on the Trump announcement yesterday that I believe is called for Liberation Day?
The announcement in terms of the tariffs were more extreme than the market expected. I think there had been a rally for a couple of days leading up to the announcement under the assumption that the tariff announcements would not be as extreme. I read a lot of analysis where some traders and market strategists were thinking that the weighted average tariff globally would be somewhere around 10%. Back of the envelope calculations based on what was released yesterday suggests it's significantly higher than that, more than double than that. On a trade weighted average, we're looking at somewhere around 20 to 25% tariffs. So those are very lofty. Some have even compared them to the Smoot-Hawley tariffs that were introduced during the Great Depression and saying they are on par with or even more extreme than those. The issue is it's hard to know we're still sort of in the fog of battle right now. The smoke hasn't cleared. We're still fresh with the announcement. We don't know how this is going to play out. It's tough to know whether these tariffs are going to stick or whether they're really being used as tactics to engage in trade negotiation with our trading partners. So the optimist in me says, well, maybe these are just, the purpose of these large tariffs is actually not to stay in place for the long term, but rather to, bring about negotiations. And then we're going to see some concessions on the part of our trading partners and those tariffs will come down. That's the optimist in me. The pessimist in me says, it's actually irrelevant, what the actual level of tariffs is, so long as we continue to live in an environment of uncertainty, right? If the main purpose of the tariffs is to, cause a kind of a renaissance for U.S. manufacturing and to impel trading partners to, to invest in the U.S. and open up factories and plants and basically jumpstart their manufacturing in the U.S. I don't think that any CFOs in corporate America or large corporations around the world will feel comfortable readjusting their supply chains and investing heavily in properties and plants and equipment manufacturing unless they have a good sense of what the tariff situation is going to be over the long term. So we're still in a state of flux on these tariffs, but it goes back to what we said earlier. Investors need to stick with a financial plan know that we are in a time of a short-term period of uncertainty, and we will get additional clarity on the tariff topic and other topics as time goes on. It's important not to adjust portfolios too radically based on short-term information that we have, which of course is very much incomplete.
Well, Tony, we are so grateful for your time today. Also, thank you for hopping on the call with us.
Thank you so much for the information, Tony. You have provided a lot of clarity. I know it's uncertain times, but I think the moral of the story is if you stick with a plan that you're comfortable with, we're going to ride out these difficult waters and end up on the other side just fine. We really appreciate your time so much, Tony. Thank you.